We should get started. Um, uh, Hopefully, everyone can see the slide on the screen. It's really the last one we talked about last year. Last week. I wanted to pick up from this point. There are a number of slides in this particular lecture. We'll finish off and then move on to the next lecture. But it's just important to keep in mind that at the end of the Second World War, the United States is in a dominant position economically and militarily. And so at Bretton Woods, the agreement ends up being a system that's very advantageous to the United States. We end up with the U.S. dollar being the main currency. Everybody's going to peg their currency to the US dollar and to gold at $35 an ounce. So dollar imbalances are going to be settled from that point on between central banks and governments, not by private citizens. So we begin to see a long period where the US dollar is being accumulated by the central banks in other countries. And eventually that money is going to circulate in Europe or in Asia as a main currency, knowing that the dollar will most likely for a long time retain its value over the local currencies. So we get to the period of time when the dollar becomes very much the international currency. And it is the job of the International Monetary Fund under the Bretton Woods Agreement to try to do what it can to make sure to try to stabilize the exchange rates between currencies, keep them from floating too much in one direction. And that's, of course, going to be very difficult because each economy is going to either spur ahead with economic development or lag behind. And so depending upon whether your domestic economy becomes an export economy or becomes an import economy, the flow of money is going to go in one direction or another. It's one reason why the Japanese committed themselves to basically domestic austerity for a very long period of time in the interest of becoming a dominant export economy. So the Japanese are going to produce goods for export much more so than for domestic consumption, provide full employment as possible for its population, and rebuild using those dollars that it brings in and other currencies that it brings in from its export activities. So every country is going to think about what kind of policies are going to stimulate exports over imports, again with this idea that if we export more than we import, we have a trade surplus that puts us in an advantageous position in the global marketplace, and it'll put us in an advantageous position with regard to the strength of our domestic currency. So in the United States, after the war ended, many economists expected that there would be a recessionary downturn as the country demobilized from war. Fortunately for the United States, because there was full employment, there was a huge pool of savings that was built up during the Second World War, and that pool of savings was immediately put to work in the domestic economy. As we all know, I was born in 1948. So I'm one of the early baby boomers. And so the young men who came back from war began to marry and have children, and they were not satisfied to stay living with their parents in what had traditionally in the United States been the multi-generation household. Now, for all sorts of reasons, the young couples were moving out. They were moving across the country to different places to live. The young soldiers had that experience of seeing the rest of the country, and so they were migrating to California and even to the South. Probably one of the biggest advances for that migration into the South was the development of air conditioning for households. So the United States population is on the move, and this pool of savings was quickly spent. Um, it lasted only until maybe 1947. But by then, there had been enough return to domestic consumption production that the United States did not have a major recession. There were a whole series of recessions throughout the late 1940s and 1950s that were triggered by rising prices, by the fact that countries like Germany and Japan and France and the UK were all rebuilding their infrastructure. They were retooling. And so in a sense, say Germany and Japan, which had its manufacturing infrastructure largely destroyed, they were retooling with the most modern equipment. The United States, which had experienced no destruction, was slow to innovate. And so slowly but surely, the producers of manufactured goods in countries that had infrastructure destruction were now becoming more efficient. And so they were starting to produce very competitive goods with the United States, which put all sorts of pressures on the US economy during the 50s and the early 60s. But one of the strongest parts of the US economy throughout the 50s and into the 60s was the automobile industry. By 1960, 3 out of 4 households in the United States owned at least one automobile. And part of what made that possible was the financial system, the beginnings of widespread availability of automobile loans. And also, of course, we had the mushrooming, an explosion in household construction, partly made possible because of the highways that were being constructed, interstate highways, and other roadways making their way into the suburbs or surrounding all of our major cities. And so here's just your typical, quote, Levittown type subdivision development. Houses that went up very quickly, cookie cutter. Most houses look very much the same. There are plenty of stories of individuals going out for an evening, imbibing a little bit too much to drink, and coming back into their neighborhood and trying to get into the wrong house because they all looked so much the same. So what made this possible? Well, first, government mortgage insurance programs provided to returning veterans and young adults, either VA mortgages or FHA mortgage insurance. All of this gave incentives to the banks to first provide the construction financing for these new subdivisions. And then, the construction loans are going to be repaid as each housing unit is sold to a private household. And that pool of money is going to constantly be rotating in and out of the banks and throughout those local economies. So the financing system in the United States was robust after the war, and full employment, growing, markets in the suburbs were creating new communities out of farmland, not just housing, but once you have housing in place, well, you need all of the public goods and services to serve those communities. And all that requires expenditure on new infrastructure. So every community that pops up, you're going to eventually have the growth of schools, libraries, hospitals, then shopping centers, et cetera, et cetera, et cetera, until in the United States, you begin to see what are being referred to as edge cities, where instead of the population simply living in these communities and then getting on a train or getting on a bus or driving an automobile into the center of the city to work, now the employment base is starting to move out into the fringes of the cities as well, which has, as you all are aware of has a lot of implications for what's happening to the inner cities of many of the cities in the United States. A loss of population, and particularly a loss of higher income households. So along with this development, here's a chart that just shows what happened to mortgage debt. And it just rose up into a peak in the 2000s before the 2008 crash. But, gradually, slowly climbing. And then when you get to the 1990s, this is when there is a rapid increase in the median price of housing. And so with the increase in the median price of housing, there's an obvious increase in the median amount of debt that people were taking on. And that's what that upward climb is all the way to 2007 and then the crash. Now, what this chart doesn't show you is after 2010, the home ownership rate will start climbing up again. But of course, we're now having another period of increasing foreclosures and evictions that we're facing, in part because of the pandemic, but also in part because of the Federal Reserve's financial policies that drove down interest rates to basically negative. When you adjust for inflation, interest rates are really, long-term interest rates are really zero. And any of you who have savings in a bank or have invested in CDs, what you've experienced is a significant loss of annual income because you've lost interest income. And it's particularly affected seniors in the United States quite significantly. But home ownership was a driver in the 50s and 60s. And by 1960, because of these policies, home ownership had climbed to 62%. So now, almost 2/3 of the population has a very strong stake in the property markets and in sustaining the increase in property values. Well, here's another chart that has some interesting implications. This is the large U.S. trade deficits, and this says they're relatively recent. Well, from the financial point of view, the Bretton Woods system worked pretty well so long as the United States remained the dominant economic exporting power. Over time, however, imports in the United States began to consistently exceed exports. So now you have huge quantities of U.S. currency accumulating in foreign banks and in foreign accounts. And the holders of those currencies weren't really interested in buying U.S. manufactured goods so much as, well, maybe investing in U.S. real estate, or investing in U.S. agricultural land, or investing in U.S. companies, shares of stock. So there's a lot of this money that's not being repatriated or not being returned to the economy for use in developing the United States capital goods stock. It's new technologies, et cetera. And it's very much of a drain on the United States economy. The question is, how do you get this money back? How do you get it to come back into the economy so it can be used for developing, expanding the productive sector of the economy? Well, in this chart, the net imports as a percentage of gross domestic product was extremely small during the 1970s when compared to later decades. So you can see the situation from a trade deficit point of view seems to be deteriorating. Now, one economist, Milton Friedman, wrote something like this. I'm paraphrasing him, but he said, why do we worry about trade deficits? If people overseas are willing to give us more goods of value than they take in value from us, then isn't that to our betterment? And what happens then to the value of our currency? Well, the currency will automatically, or should automatically, adjust based on those differentials in exporting versus imports. So all of this currency is out there. Friedman is basically arguing that if we just allow the value of our currency to float, then it will find a new equilibrium that represents where we are in terms of our imports versus our exports. The politicians weren't willing to let the system just do what it's going to do. There's a great deal of concern, of course, that we're losing our dominant position in the United States. And so by 1971, foreign holders of US dollars began to convert their holdings to Deutschmarks. They were losing confidence in the United States dollar. It was, Germany suspended its intervention and allowed its currency to float upwards. France and Britain announced that they would begin to convert their dollars into gold. So what did Nixon as president had to face? He had to face, well, do we allow this to happen? We set the price of gold at $35 an ounce. But if all of these holders of US dollars want to buy all the gold at $35 an ounce, we're not going to have any gold left. So Nixon decides, with advice from his economic team, that they should close the Federal Reserve's gold window, and this will halt the outflow of gold. So here again, it gets back to this very basic idea, this perception that the financial health, the wealth of a country is in some way measured by how much gold and precious metals it has stored in its vaults. And the United States was fearful of losing its stock of gold to other countries and therefore losing its standing among the economic powers of the world. Nixon also put a 10% surcharge on imports in an effort to force other countries to revalue their currencies against the dollar. And here again, we get back, if you go all the way back to 1929, one country decides to raise its tariffs and adds costs to imports. Well, are other countries going to retaliate against US exports? And of course, they will. No country wants to be on the losing end of that kind of trade war. Well, it didn't work. The arrangement just lasted for 2 years. In 1973, the Bretton Woods Agreement actually collapsed. Now there is no longer a requirement that any bank, even a central bank, hold gold, although many do. And global banking has functioned as a no reserve system ever since, meaning that nothing tangible has to be held in reserve to back up the currency. Paper currencies are issued and held as reserves. Other financial instruments considered liquid, such as government securities, also make up a portion of bank reserves. So we've moved very quickly away from, in the 20th century, we moved away from the gold standard, from any idea of a full reserve system in terms of tangible assets, precious metals, to a fractional reserve system. And now we have basically a no reserve system, which means that the value of our currency is based on public confidence. So long as people have confidence that the money that they get in return for their labors, when they go to the stores, they'll be able to purchase the goods that they need, and prices are reasonably stable, people will remain confident in the currency. And in many countries where they're not quite as advantaged as the United States, political problems have caused the loss of confidence in currencies. So you have the situation in a country today like Venezuela, where the domestic currency has really, just disappeared in value. And there's all sorts of underground economic activity going on, and other currencies that are more stable, if you can get them, are the basis for exchange. So there's no global system that's really in place, and the uh, the responsibility of the International Monetary Fund. What's it doing to stabilize these situations? Well, it's very difficult to use monetary policy by itself to stabilize the economics in any country. Um, there's a great need for some balance between monetary policy, fiscal policy, and economic policy. And unfortunately, um, are the the elected officials in most countries, along with economists, haven't really figured out what that balance ought to be. At least not in a sense that it's resulted in the kinds of policies that have had the desired results. So we're still, it seems to me, struggling to try to find this balance. And so there's a lot of concern today about, a lot of discussion today about all sorts of systemic issues that need to be dealt with in terms of our economy and our financial system. And conferences are being held all the time to try to come to terms with this. Well, in the 1970s, the early 1970s, you think about what was happening. Here's just a collage of some images. OPEC, gasoline shortages, the war in the Middle East, and all sorts of other problems. So geopolitical forces were ready to impose a degree of stress on the stability of the international financial system that would have to be addressed. Any questions up to this point? Anything from last week that you remember that you'd like to ask about before I move on to the next session, next lecture? Jerome? Oh, that's Marty.
Ed, hi. Yes, I had a question about I'm not quite sure the right name of it, but basically the highest tax rate that was in place for personal income taxes during the 40s, 50s, and 60s leading up to 1970, because I think that's dramatically changed in more recent years. And just curious if you have access to those numbers.
As I recall, it was 87%, but that was a notional rate of taxation on the highest marginal incomes. Mm-hmm. You have a 1,000-page tax code. So if anyone was subject to paying 87% on some marginal amount of income, I would think that would have been rare. But it is also the history of our economy does show that we did quite well in terms of real economic growth during these periods of high marginal tax rates on high incomes and on high corporate income. So the argument for low marginal tax rates, in my view, doesn't really show a direct connection with the economic health of the country. It's not the only factor, of course. There are many other demographic factors at work. You have to think about, for example, new family formation. In the early 1970s, there's just millions of new, young adults coming out of high school, either going to college, coming out of college, pairing up, starting families, beginning to have children. And so you have, enormous increase in the demand for all basic needs. Just the number of schools that were constructed, the dramatic increase in young people attending college and universities, starting new households means you need new apartments to rent if you don't have the ability or the savings to immediately buy your first home. And then once you do get that first home, what are you going to do? You have to fill it with everything you need, the furniture, the appliances. So the demand side of the economy was accelerating, and although we were importing many goods from overseas, the United States was still, a very strong manufacturing producer. And in fact, the latest statistics that I've seen, what's interesting is our manufacturing output in the United States today is higher than it's ever been, but we're doing it with far fewer people. I mean, that's the catch-22. And we are producing many more high quality manufacturing goods, but we're doing with a labor force that's much smaller than it was a generation ago. I had a story about, there's a plant. It was I think it's Mercedes-Benz built a new assembly plant in Virginia for one part of their aircraft. I'm pretty sure it was Mercedes-Benz. They were building something for Boeing, some parts for Boeing, a state-of-the-art plant, and they spent, a huge amount of money building it. It has 100 employees, and that's it. So again, the capital investment is there, but the question is, as we move towards automation, what do we do with the people who were once in manufacturing? And we've, can they all be retrained, and where will their employment opportunities be? So, boy, I really went off the beaten path with my answer by your question about marginal tax rates.
That's all right. That's right. My other question, which you may be getting into in the next segment, was about how inflation really took off in the 70s up until the early 1980s, I guess, when Reagan came in and then started to back off a bit. But I remember interest rates way over 10% at one point, and mortgages were so much more expensive back then. And
oh, sure.
So.
Well, I mean, we're now getting into the 70s is the beginning, for all the reasons that I showed on that last slide. OPEC is formed, the war in the Middle East, there's just a dramatic increase in demand. And, we are a population addicted to the automobile. So, for a long time, we're still driving these gas guzzling cars, and so we are importing more and more oil. We're becoming more and more dependent upon foreign, sources of fossil fuels. And OPEC decides, well, it's time for us to come to an agreement on controlling supply and controlling price. And so we get, stagflation. And economists up to this point in time were pretty much convinced that what was called the Phillips curve was real. And, Phillips did a statistical analysis over history and basically said that there's a trade-off between inflation and unemployment. So, I've seen the Phillips curve, and I've seen the data points on it. I have a hard time. Polly Cleveland's here. Maybe she can comment on this, on the Phillips curve. But I look at the data points, and I have a hard time finding the curve. It looks like there's not a real curve there unless you really look hard to see. But the trade-off, supposedly, Phillips said, was that when you have high unemployment, you will have low inflation or deflation. And when you have high inflation, you'll have low unemployment. So, Polly, do you have any thoughts on Phillips?
Well, the Phillips curve was fashionable for a while. I think it is now totally dead and buried. It was controversial even when it was proposed, but now, there just doesn't seem to be any meaningful relationship. Let me add one comment, though. You're talking about the high marginal rates during World War II and following really up to the Kennedy administration. I think a good case can be made that those high rates actually stimulated investment. I mean, if you're going to be taxed high marginal rates on either corporate income or personal income, well, you might as well invest it and get something for it in the future. Because I know there's people even like Krugman who say, oh, well, it was the war spending that got us out of the Depression. And I would say, well, maybe, but it was the high rates that stimulated investment. So my 2 bits.
Yeah. Plus, I'd add to that the ability to get tax credits for investment for particular types of investment.
Mhm.
I mean, if the government says if you build a new plant and equipment, you innovate in technology, we'll give you a tax credit for that investment. That's an inducement to do exactly that. But if you just simply reduce the tax rates and lower them without any particular design, then what you're going to get is a lot of speculative. We got feedback. I don't know where we're getting it from, but somebody has their mic on that we're getting it from. It wasn't yours, Polly. So, okay, it's gone now. We got several questions. I think, Alec, you were first, and then Wayne and Joe.
Yes, thanks, Ed. With respect to the issue of inflation in the 70s, it was not the usual kind of inflation that came from an increased demand. It was supply induced, that the supply of oil was reduced, the price of oil went up, and that engendered all sorts of increases in prices in the product and services market. And when President Reagan came in, he essentially said, hey, if I'm faced between reducing inflation and reducing employment, I'm always going to choose, as a conservative, I'm going to choose reducing inflation, which he did. And that's what sent the unemployment rate to 10%, the biggest unemployment rate, the highest unemployment rate since the Great Depression. And it wasn't as if he or his administration did anything. Essentially, the world was lucky in that oil was found in other places other than OPEC.
Exactly right.
In North Sea, in Mexico and Venezuela, etc. So the prices of oil went down, and with that, inflation as well. It wasn't anything that the government did that reduced the inflation, because it was supply induced and not demand induced.
It took a little while for an equilibrium to find itself that was a balance in the global economy. Here we go again with the echo.
Alec, you may want to mute.
Here we go again.
I can't hear you anymore.
Okay,
Go
Wayne.
ahead, Ed.
Yes, this is Wayne. In regard to the very high marginal tax rate we had during the 40s and 50s, one way around it was to try to convert current income to capital gains, because capital gains was taxed at about half the rate of regular income. So if your value of your company went up, or you decided to cash out, and you cash out for a much higher price than you paid for it, whatever you're selling, you cash out and you have much lower marginal tax rate. So a lot of the times, very few people actually paid that super high tax rate.
Yeah, I agree. I mean, that's the point I was trying to make earlier. My observation also has been, I've tried to write this in numerous ways, that there is no such thing in the real world as a capital gain. A capital good, a tangible asset, I don't know of one that does not depreciate over time. And so we have this what we call capital gains on the sale of assets is almost always a return to passive investment or speculation. So if we were going to really have rational tax policy, my view is that we should eliminate any distinction between the rates applied to income from different sources. and simply have a progressive rate of taxation on all income, exempting some level of income, my choice would be the national median income. And we could combine tax simplification with real progressivity, and therefore it would tend to capture unearned rent-derived income at the higher levels of income. Joe, you had a comment or question?
Yeah. Great presentation as always. Just want to make a few remarks here. First of all, your comment about the capital gains. I think Reagan actually did do that. And then, you know, a dollar earned didn't matter which way. And then, of course, the Republicans eventually kept giving breaks to capital gains. And I quite agree with your comment about depreciation. About the borrowing, I think it was during the war that Mary was talking about there. Both Keynes and Friedman said that it was good to issue bonds in wartime. That was about the only time they wanted to issue bonds, because it drained away purchasing power and helped prevent inflation. And the item about the Phillips curve, last year, Powell at Jackson Hole, their annual conference there, he admitted that there doesn't seem to be any real strong relationship anymore in that regard. And he also said that that belief may have contributed a lot to inequality, which was, you know, pretty great admission, particularly coming from a Republican appointed governor or Fed chief.
Yeah, well,
Let me just turn my volume off here.
I guess the best comment I have is that sometimes the facts actually influence policy and influence the views that people have. So the period of time that we're getting to, the late 70s, early 80s, is certainly one of a great deal of discussion about not just economic and financial theory, but the whole theory of governance. So, you know, when you talk about Reagan, it's hard to separate his ideas about economic policy from his ideas about new federalism and the general view he had about the federal government should not impose unfunded mandates on the states. It's that kind of thing. You throw in supply side economics and the influence of Jack Kemp and Art Laffer in those discussions, and we're going through a period of experimentation where we're going to find out that these ideas really have substance. You know, are these theoretical positions, do they have merit in the real world, and how do you control for externalities? I mean, this is the, I guess it's the wish of economists generally seems to have been since the beginning of the 20th century that economics could be as solid of a science as, you know, Newtonian mechanics, but how do you control the variables and when human beings are involved and socio-political systems are involved? I think that's where we run into a lot of these difficulties with what policies are going to work for all time, what policies are going to work to deal with short run issues, like you said about, you know, issuing bonds during wartime. Well, there's plus and a minus there when you think about it. Again, I think I mentioned this last week. Most wars are paid for by debt that comes from borrowing from those who have and then charging interest on that debt, which has to be paid by broad-based taxation on the general population. So to the extent that the average family bought savings bonds during the war and got a couple percentage points of interest income on that, I would, it's probably fair to say that most of that interest income was then taxed away by their other forms of taxation. But why not impose, higher marginal tax rates on those who are have the highest, incomes and the highest net worth at a time of national crisis, when those are the people that have the most to lose if the crisis turns into catastrophe. And so that's in part an economic issue, but it's also a question of justice and fairness, and where do we find the right balance? It's again, to me, it's a balance. It's an attempt to balance property rights with human rights and civic duties. And we can't just look at those from a financial position. Well, let's get back to the history a little bit, and we'll build up a little bit more to talk about what happened during the Reagan period. But as I've told you, I spent 20 years at Fannie Mae, and I worked in several management capacities there, as well as in an analyst capacity, looking at regional markets and what the housing needs were in those regional markets. So I always say that I had an opportunity to really work in the trenches to see what was going on. And it's clear that Fannie Mae and Freddie Mac and the federal home loan banks, all of which were created, by government to try to meet an unfilled need in the economy, which was a combination of providing some sort of insurance to protect banks from excessive risk, while controlling the risk that they were taking based on sound credit analysis and prudent lending practices. So we had the three government-sponsored entities, and each was established during the 1930s in response to the collapsed private sector lending to consumers for the purchase of a residential property. In the 1930s, you could not get a 30-year fixed-rate mortgage. You bought a home, you probably got a 3 or a 5-year loan with a balloon payment. And at the end of that 3 or 5 years, if your circumstances had changed, or the bank felt that it was an excessive risk to make that loan to you, you would have to struggle to refinance the loan or pay it off. And you could very easily lose the property because you're unable to pay off the first mortgage loan with new financing. So Fannie Mae and Freddie Mac and the home loan banks filled that gap, and they gave stability to the housing sector in the United States in a way that never existed before. The piece of legislation that started it all was the Homeowners Loan Act of 1933. And this created a new entity authorized to provide refinancing to borrowers out of these short-term mortgage loans and into long-term fixed-rate financing that amortized over the life of the loan. Funding to this entity for the new loans ended after 1936, however, but it continued to collect mortgage payments until it was finally shut down in 1951. But one thing about amortization that I ask you to think about is, for most of the period of bank lending over these long-term loans, people were asked to make a 20% cash down payment, unless you got an FHA or a VA, mortgage loan. So for most of the 50s and 60s, that 20% cash down payment equated to you using cash to purchase the land under your house. And you financed the housing unit over 30 years. Well, it made sense because a house basically, even if it's well maintained, will significantly depreciate in its condition over that 30-year period. So amortizing the loan over 30 years basically acknowledged the fact that with each year, the housing unit is going to lose some of its resale value. Depending on how much you as an individual invest in upgrades and system replacement. So at best, most people after the end of their household experience, if it wasn't for the increase in the value of the land under their house, if they were to sell that house, they would at best get back their purchase price plus some portion of all the money they spent on maintenance and systems upgrading. So the idea of a fixed rate mortgage loan amortizing over 30 years really made it possible for a lot more people to become homeowners and to have the security of homeownership. It also gave, of course, to the financial institutions a strong sense of security that they would be protected from downside risk because of mortgage insurance. Well, what next happened? Well, the Congress and the Roosevelt administration concluded that a lot more was needed to be done to support home ownership. It became a social policy to increase the rate of home ownership. So in 1938, there was an amendment to the National Housing Act that established the Federal National Mortgage Association, which eventually became known as Fannie Mae, just because of the initials FNMA. At some point, some creative person said, instead of FNMA, we're going to call this entity Fannie Mae. And it was a government agency. It had a mandate to create a secondary market to purchase for its own portfolio and sometimes sell FHA insured mortgage loans originated by private lenders. So at that point, the secondary market for conventional loans was really not targeted by the government. There was a growing secondary market. There were investors, particularly insurance companies, would invest in pools of long-term fixed rate loans originated by the banks. And that's why the 20% down payment was a basic requirement. And that held pretty firm until property prices started to increase across the country to the point where potential home buyers could no longer easily save 20% of the purchase price, as well as the amount that was required for closing costs, which could be, considerable depending upon where you live. Real estate transfer taxes, buyers and sellers each charged like 1% of the purchase price. You had to get title insurance. You had to put in escrow for property taxes and fire insurance, et cetera. So, so a lot of innovations had to be put into play to keep the transaction volume up as the decades passed and as property prices increased. But in the beginning, slowly but surely, more and more households were gaining home ownership. In 1944, there was the passage of the GI Bill. The actual name is the Servicemen's Readjustment Act. And this created a special mortgage insurance program within the VA. And Fannie Mae began to purchase these VA insured loans in 1948. Now, for the most part, what this meant was that Fannie Mae was a big S&L because it purchased these loans for portfolio. It didn't really have a program to resell them to other investors. And as long as interest rates were reasonably stable, as long as inflation was under control, this made pretty good sense, because the average years of home ownership were something like eight years initially, maybe 8 to 10 years. And so a lot of properties were turning over. So, if you're holding these mortgage loans, you have a sense that there's an anticipated life of how long you're going to have to hold them. And so even though, for example, if mortgage interest rates are going up and your cost of funds is going up, that means you're losing money on loans that have a lower rate of interest on your book, but you probably can get by with that because the new loans that you're putting on the book are covering the spread a little bit better. Well, so all that's going on. I mean, you can just think of how dynamic this market is becoming. Growing household population, household formation, many more people looking to become first-time home buyers. There are demographic changes where some cities are growing by leaps and bounds. Other cities are beginning to lose population and contract. You have neighborhoods that are losing value and losing population. And at the same time, in the surrounding suburbs, you have climbing property values and an outmigration of population, all needing either rental or ownership housing. So by 1954, there's a recognition that things need to be changed. And Fannie Mae's charter was modified in 1954 to transform the agency into a public-private mixed ownership corporation. And this is the beginning of a long process that ended in 1968 when budgetary deficits during the Johnson administration caused Fannie Mae to be put on the market. The Vietnam War was costing a lot. The war on poverty is costing a lot. Johnson needed revenue, and one way they thought they could raise additional revenue was to sell the government's interest in Fannie Mae. So it became rechartered as a for-profit, shareholder-owned entity, and it came out of the federal budget, raising its financial capital through the stock and bond markets. It's still, at that point, a huge S&L. It's still a portfolio investor holding on most of its mortgages. And then in 1970, we have a new piece of legislation that created Freddie Mac, the Federal Home Loan Mortgage Corporation, FHLMC, Freddie Mac. And its charter was to support the nation's thrifts, the savings banks and the savings associations, and help them manage interest rate risk by purchasing their long-term mortgage loans. So Freddie Mac steps up to the plate in the same way Fannie Mae stepped up the plate for government insurance loans. Now the S&Ls, which are going through the same in the 70s, they're about to get hit with rising interest rates, rising cost of funds. And if they're sitting there with large portfolios of 4 or 5% yielding loans at a time when their cost of funds is 9 or 10, it doesn't take much of a financial genius to see you're in serious financial trouble and you're soon insolvent. Well, thanks to Freddie Mac, they were able to sell those loans to Freddie Mac, and Freddie Mac then had the same issue as Fannie Mae. Well, what do? Our cost of funds is increasing. The yield on these loans is low. So what did Freddie Mac come up with? It came up with the first mortgage-backed security that was collateralized by these loans. So now basically Freddie Mac and then Fannie Mae now have the ability to issue these mortgage-backed securities, which will have a selling price in the market based on the weighted average yield of the collateral of the loans that collateralize the security. And so you have a liquid asset that now becomes very saleable in the bond market. And so Freddie Mac and Fannie Mae can pass on the interest rate risk to some extent to other institutional investors, both domestic and foreign. But a lot of pension funds, a lot of insurance companies start to invest in the mortgage-backed securities, and even banks bought many of the mortgage-backed securities to hold in their portfolio as assets. Because the securities are considered a liquid asset, it means that they are required to hold much lower reserves than if they were whole loans. And that's a big selling point for the banks. So it might have been, I'm trying to remember the exact amount, but this goes back to the early 2000s. I think whole loans where you had to hold like 8% reserves. For a mortgage-backed security, it was like 4. So that's a pretty considerable, advantage to hold mortgage-backed securities over whole loans. Any questions? I know that's pretty complicated stuff. Anybody have any questions about what I covered? Like confuse the heck out of you? Okay, I'll take that as a no, but or maybe you don't know what question to ask. Anyway, so the securitization of these mortgage loans now pass the interest rate risk on to the private investors. On the plus side for investors, the securities are liquid in the same way as a bond. Despite the existence of this secondary market, however, many thrifts, strangely enough, elected to hold on to their mortgage loans as a portfolio asset. One reason was that they were pretty conservatively underwritten, and also many thrifts dealt with a local community. And so they felt an obligation to their borrowers who were also depositors. And so selling the loan was viewed by many of them as inconsistent with their commitment to their communities. But it was not a decision that they would eventually think was beneficial, because the market value of the loans began to fall, and their cost of funds started going up enormously. So into the 70s, the US economy is hit by stagflation, unemployment increases. So when unemployment increases, delinquencies on these loans increases, foreclosures started to climb. And in fact, both Freddie Mac and Fannie Mae were also experiencing huge losses, and their balance sheets beginning to look pretty precarious as we went through this period of stagflation. So there had to be something done. Political leaders in the US and their economic advisors were committed to a long process of deregulation of the financial services sector. The argument was made that the government should be less involved in these parts of the market. Look what we've exposed the taxpayer to by having standing behind the GSEs, behind Freddie Mac and Fannie Mae and the home loan banks. How much is this going to cost the taxpayer? And so the argument for deregulation began to build up in the financial services sector. And economists were arguing that the markets should rely on competitive forces to discipline the activities of the players. And we should get out of the regulation business. A lot was happening. The pressure of the banks was also increasing for this, because by the late 1970s, you had major financial institutions outside of the United States that had grown to be enormous. Japanese banks, German banks, other European banks. And US banks were starting to feel as though they were being crowded out of the global credit markets and wanted much less regulation so that they could expand their activities. And they could, when they thought advantageous, began to merge and acquire other financial institutions. So in 1978, there was a landmark Supreme Court case. This was Marquette National Bank versus First of Omaha Service Corporation, in which the Supreme Court ruled that nationally chartered banks could charge borrowers a rate of interest based on the maximum rate of interest permitted in the bank's home state. This was the beginning of the elimination of usury restrictions on interest rates. Banks now had a financial incentive because of this ruling to relocate their formal business address to the states with the most bank-friendly regulations. And the two states that responded most significantly, one was South Dakota. Does anyone know the other one? Where the most, what state would you think of when you think of the most bank-friendly regulations?
Delaware.
Delaware is exactly right. So South Dakota became the new center for the credit card industry because, with credit cards, there's a strong effort to price for the risk. And so, it's kind of a catch-22. Those individuals who have the weakest credit scores and they apply for a credit card, they're going to pay the higher rates of interest, even though they need the credit the most. So in order to get the profit margins that the banks are looking for, South Dakota said, come on in. We won't impose any limits on the interest rates you can charge on your credit cards. And Delaware became the home for, I don't know how many major corporations in the United States, but there's a little building on the outskirts of Wilmington, Delaware, that is the drop box for hundreds of corporate entities. And I saw a statistic about 8 or 10 years ago that $1 out of $4 raised by the state of Delaware comes from the fees and taxes generated by these corporations that don't really do any business in Delaware, but their legal domicile is in this building. So it's very interesting, how politics dictates economic outcomes, and in the financial sector, the states in the United States are playing against one another, countries are playing against one another, and without international treaties that deal with these, you have a very, I guess you'd say, bizarre sort of incentive systems for financial institutions to do what they do, locate in the Cayman Islands or some other tax haven place. And the question is, well, why don't governments deal with this? Why are we still permitting a lot of these things to happen? Well, the act also increased federal deposit insurance from $40,000 to $100,000. And this required all U.S. banks to hold reserves at the Federal Reserve. And again, what this meant was holding reserves was either Federal Reserve notes or government securities. But what do you think? It sounds really great that they increased deposit insurance from $40,000 to $100,000. Do you see any downside in making this change? Any thoughts about that? So all of a sudden, okay.
Taking much greater risk because you're insured.
That's right. That's right. Alec, you got to go back off.
Yes,
but you're absolutely right. Now you've given the bankers a license to take greater risk because they're not going to be afraid that their depositors are going to come and run on the deposits and take their money out. So it is a problem in the sense that bankers are looking around for higher yields, higher nominal yields, But if you don't know how to price for the risk or underwrite the risk based on your experience, you're liable to make some bad decisions. And in the 1970s, we see the beginnings of a lot of this happening, a lot of problems with people who are on the boards of a savings association or a small bank or an S&L, basically using their influence to get special financing for development projects that aren't well thought out, construction loans that are made and soon find they're in default, and puts a lot of the thrifts in a desperate financial situation as more and more of their assets start to be underperforming. Now, the other thing that's also happening at the very same time is in the early 1970s is the first formation of the money market mutual funds. They start out small, but slowly but surely, the money market mutual funds are advertising to average people. And so you see an advertisement, you have your money in, let's say, your local savings bank, where you, in your community, in your neighborhood, your family has banked with that community bank all these years. But now you see an advertisement from the money market mutual fund that says, hey, if you're getting 2.5% on your money in the local savings bank, we're offering you 5%. So gradually, and then at an accelerated rate, people started to withdraw their savings from the savings banks. And so now the banks, in order to make loans, have to go out and compete with, they have to find money in order to make new loans. And they're having a more and more difficult time because they have not yet gotten the legislation that allows them to compete with the money market mutual funds. And so they're in a very difficult situation because their cost of funds is climbing and the yield on their assets is not. So the thrifts began to experience increased losses on their low yielding fixed rate mortgage loan portfolios. They started to rush to try to securitize a lot of them. But what happens then, of course, is you put, let's say in your portfolio, you have $100 million of loans that are yielding an average of 5%, but the current cost of funds is 8%. So what's that bond worth? It's not going to sell at par. You're going to take a heavy hit. It may get you, instead of $100 million, it may you get 80 million. So now you have a $20 million loss to record. That could very well make you insolvent. Well, one of the things that the Congress did, the banking regulators did, to sort of ease the pain a little bit, they allowed the banks to amortize these losses as the payments came in. What that means basically is, as you make your mortgage payments to the bank at 5%, and their cost of funds is 8%, they take a 3% loss that they record on their books. So they didn't have to record the full $20 million in losses on the sale of their securities right away. And it helped some of them survive, but hundreds failed into the early 90s. Here's a chart that basically shows you what happened with bank failures beginning in the early 1980s. I mean, it's really hard to imagine how bad it got, but that's just a rough idea. You know, in the peak year, which is 1989, there were 550 banks that failed in that one year. I was still managing the mortgage department for Provident National Bank in Philadelphia at that point, and we had a rough couple of years. my loan committee, interest rates were starting to go up, and our loan committee called me in for a discussion of what we should do, and they wanted to actually close the window to lending altogether. And I said, well, if people can afford to pay 10 or 12 or 13% for a mortgage loan and carry that debt, why shouldn't we make the loan? And then if rates go down, they can always refinance later. But a lot of bankers did think that the rising interest rates were beginning to become a real problem. Well, fast forward a few years, Reagan's in office, right? And oops. So 1982, we get the Garn-St. Germain Act. And this legislation authorized the thrifts to engage in making loans to commercial businesses up to 10% of their assets, and also then allowed them to offer certificates of deposit in competition with the money market mutual funds. But that's, quite a few years that they're not able to compete. And so for many of the thrifts, this new authority only pushed them to take higher risks for which they had no expertise, trying to get high nominal yields and a return to profitability. And many of the thrifts simply made terrible decisions to get involved in things like shopping center construction loans. And they didn't do a lot of good market analysis. For example, there is one story, I forget one, it was a town in Louisiana, population about 50,000. And they had a large shopping mall. And the local thrifts pulled their assets together to build a competing shopping mall. It was already determined that one shopping mall was plenty for that town. And so what happens, you provide the construction money to build it, and then you have to find tenants. And the stores know what the game is, and so they had a heck of a time getting an anchor tenant for the shopping mall. And eventually the mall the owners defaulted on their construction loans, and it brought down several S&Ls in that market because of that one major commitment to finance the shopping mall. And that went on all across the country with these small thrifts that had really no expertise in beyond simply making fixed rate mortgage loans to households. Well,
Ed,
yes.
Before you move on to Reagan, I still have a question on the FDIC Act, which was under Carter.
Okay.
Right? Yeah. Do we know what percentage of depositors had more than 40,000 worth of savings to be catered, to be provided that insurance, or was that a boon for the banks, like to allow them to give them this cushion of protection in order for them to go out and be more risk takers?
Yeah, well, I don't have the exact percentage, but it was low. I mean, at that point in time, and it's still the case today, most of the net worth of households in the United States is the net worth they have in their residential property if they own one. From those people who do not own a residential property, the median net worth is under $10,000 of what they have in terms of savings or stocks, whatever. And so the question is what percentage of households would have needed that extent of coverage? And the answer is not many, but there in each community where savings banks exist, there's some percentage of the I guess you'd say prominent households in the community that would have a good deal of their savings in those thrifts, and therefore this protected them. And so it made them less likely to remove their assets, their deposits from those local banks. And particularly, it was then strengthened when the SNLs got the authority to compete with the money market funds by issuing certificates of deposit. And the certificates of deposit would then be insured. So
Thank you. That explains.
yeah, I've seen the statistics, Giannis, but I can't remember, but I can tell you it's fairly low. And we went through a period not too long ago where the negative rate, savings rate in the United States was negative. So you have more and more households living paycheck to paycheck and in perpetual debt rather than having any savings in an account anywhere. Now, this next chart I'm showing you gives you an indication of the ramifications for all this. This is the Federal Savings Loan Insurance Corporation fund, and it shows how much it had in the fund up until the financial crisis of the late 80s, when we had the S&L crisis, and then having to bail out all the S&Ls that were failing was really costly. The fund held about $6.3 billion in reserves at the time, but it cost $25 billion to bail out all of the insolvent institutions. There was really weak federal oversight. And then we had the passage of the Tax Reform Act of 1986. And what that did was reduce the need for those with higher incomes to shelter income by using the thrifts to invest in real estate. So 1986 Tax Reform Act meant that you could only deduct interest from your income if loan interest, if it was a secured loan. So people, stopped getting unsecured loans and started taking out second or third mortgage loans on their residential or commercial property. And it very much changed the risk reward ratio for the thrifts. So it created a whole different avenue for investors. Instead of the thrifts, people started to buy shares in real estate investment trusts, for example. And that I'll go into a little bit more detail about that, but the laws regarding the real estate investment trusts created another potential firestorm, because one of the conditions was the REIT had to distribute 90% of its profits. And so there was not much left in reserve if things started to go bad. Well, so during this period, the Congress was forced to recapitalize the insolvent insurance fund, and they put another $10.8 billion in it in 1987. Where'd that money come from? It came from general tax revenue. It should have come from, of course, premiums paid by the thrifts, into the insurance fund based on what any insurance company will do, and that is assess the level of risk involved and then charge you a premium. But that obviously wasn't done, and that's why. Or you can say that the depth of the crisis was such that ordinary premium payments into the fund were insufficient. And so under extraordinary circumstances, the government was justified in bailing it out the way it did. You can make your own judgment on that. There's been plenty of criticism written about how the premiums were established and how individual ratings of the institutions were forged. We used to get they're called IDC reports every quarter that ranked all of the institutions that we did business with at Fannie Mae by 1 to 300. 1 was the best, 300 was terrible. And so, whenever we would get these ratings and we would see that there were some customer lenders we were doing business with that were way down on the list, we would start thinking about maybe we should go in and pull their servicing portfolios from them and reassign their servicing portfolios. And we did some of that stuff. Actually, sent like groups of guys with the truck unannounced to a lending office that was in trouble, financial trouble, and with a court order, and went in and took out all the files and shut them down because they were considered to be too high of a risk. Anyway, 1989 comes. Bush signs into legislation a law that bailed out the surviving thrifts, transferred the remaining insurance funds to the Federal Deposit Insurance Corporation, and they created a new regulatory agency called the Office of Thrift Supervision. So, Republican administration, but 1989, they realized that things had gone too far during the Reagan era into the realm of deregulation, and something had to be done. Still major problems to deal with. To oversee the dissolution or merger of troubled institutions, another entity was created, the Resolution Trust Corporation. Nearly a half of all savings institutions then disappeared, and this cost taxpayers about $210 billion. Between 89 and 95, the RTC closed or otherwise reconstructed or merged about almost 800 thrifts with an asset base of about $400 billion. $400 billion in assets, liabilities probably in the $700 billion range. So the difference is the losses after the sale of the assets of the thrifts was made through Resolution Trust Corporation. They had a couple of different headquarters. One was in Valley Forge, Pennsylvania. And the guy who headed my bank's commercial real estate group actually left the bank and went to work for the Resolution Trust Company and took corporation as one of their senior people. Well, another major component of financial deregulation occurred under Clinton. And this was, anybody want to guess? The gradual unraveling of the Glass-Steagall Act. Remember the Glass-Steagall Act adopted in the 1930s to separate investment banking from commercial banking. The banks made their case that this was no longer needed, that they knew what they were doing. They knew how to assess their risk and price for their risk, and they were doing things prudently. So the process began in December of 1986, when the Federal Reserve issued a ruling that permitted banks to generate up to 5% of gross revenues from investment banking activity. And this was then soon expanded to permit the banks to handle commercial paper, to handle municipal bonds, and to handle mortgage-backed securities. So we're now really getting into the era of the bank holding companies and away from commercial banks operating as sort of independent entities. How did that work? Well, depending upon your perspective, it worked well enough or it was a disaster. The pattern of deregulation, however, accelerated when our friend Alan Greenspan was appointed chairman of the Federal Reserve System. He believed that he was convinced that the banks could pretty much regulate themselves. And so he, stepped back and to the extent the Federal Reserve had the capacity to really monitor bank activity, Greenspan thought that it was no longer necessary. And the real end to all of the oversight came when Clinton signed the the Financial Services Modernization Act in 1999. And the result of that basically was to open the door for consolidation of the financial sector, as commercial banks, investment banks, securities firms, insurance companies were all now allowed to acquire one another and to merge. White House papers made public in 2014 revealed that there was only very limited discussion on the risks of such deregulation. There was just sort of an acceptance that the financial sector had matured. And so this is, again, the banks are arguing, the financial companies are arguing, we have to be competitive with the huge banking financial conglomerates overseas, or we're going to lose our status. So this chart that I'm showing you here shows what some of the mergers are. Travelers, Citibank, Nations Bank and the Bank of America, JP Morgan, Chase, Bank of America, Fleet. I mean, all throughout the country, everywhere, what you could see almost on a weekly basis was construction workers coming in and taking down the banner of your local bank and changing it to some other bank. And then a year later, coming around again and taking down the new banners and putting up the new name. So that, you know, today, probably, if you go into any major city, how many different banking entities are you going to see? 5 or 6, maybe. Five. And in some cities, fewer than 5. Yeah.
So Ed, if I could have a moment, you know,
Yes.
a psychological, sociological sort of statement. If you take a look at the photographs that you showed us over time, all of them are of men, at least middle-aged and higher, no women, all of them wearing dark suits or gray suits with black ties or dark blue ties. I mean, the level of conventionality of dress implies conventionality of thinking and imagination. Is just extraordinary to me. What one can gain, perhaps, even with a jump on my part as well. But nevertheless, it's very disturbing, I must say, to me sitting here listening to you, seeing these pictures. There's you know, fudging a little bit. There's no conception that somehow or other there is a systemic element that is gone awry, and attend to that, rather than, you know, small changes here and there.
Yeah, I mean, the sociologists and psychologists, I'm sure, have a lot to say about this. I mean, I think about my own evolution from being a young person, going to college in the late 1960s, being somewhat involved with radicalism. We had a local chapter of the Students for a Democratic Society on our campus, and I was involved, and I really thought the establishment needed to be overthrown. And I graduated from college, got my hair cut short, and started to wear 3-piece suits, you know, in order to start my career. It's like, I often thought about that, you know, and I was naive enough at the time to hold on to my political ideals and think I could be a change agent within the corporate sector. And I'd like to think that, you know, that I was able to do some good in 40 years working in the financial sector, but a change agent, not at all. I mean, we went through a long period of time, and we're still going through it, where confidence in markets just became unrealistically optimistic. And whether or not we're now beginning to get back to a recognition that market players, number one, don't always play by the rules, even when the rules are well enforced, nor are they invested with insight into the future. I mean, we need to have strong regulations in place. We need a level playing field, but society has a strong interest in my view, in putting limits on what these entities can do and what their social responsibilities ought to be. But not everyone agrees with that. There's still plenty of people who think that corporate entities have no social responsibility and only a responsibility to shareholders. Now, it may be also a strong correlation with the number of MBAs that were issued during these decades. I mean, there are many stories of the fact that that in the MBA programs at major universities in the United States, there was no course on business ethics until probably fairly recently. So we have the system we have, and you're right. I mean, diversity in the corporate, boards needed to be expanded, and we needed to have more people in the decision-making positions who simply had a different view of what the system ought to look like and what responsibilities their entity had toward the general public.
Ed, there's another question or comment. Go ahead, Mary.
Oh, Wayne, I'm sorry.
Yeah, go ahead. Go ahead.
Wayne?
No, Cleveland.
I didn't put up my hand.
Oh, well,
I should lower my hand. Yeah. Okay.
Somebody else had a question?
Me.
Paulie has a question.
Not a question, but during this period you're talking about the S&L crisis, there was continuing massive corruption scandals.
Yeah.
I mean, Gil Black, I think he was with the Resolution Trust, but he wrote a book with a marvelous title, which is "The Best Way to Rob a Bank is to Own One."
Yeah.
And there was the Keating Five, and all sorts of compromised Congress people. And yet at the same time, as you said, the banks were posing that, oh, well, we know how to do our business now. And right against the background of these massive corruption scandals, which is, of course, why it was so shocking that, I think, hundreds of bankers went to jail for fraud, which is why it was so shocking that Obama did nothing after 2008. Nobody got prosecuted.
Yeah. It's now past 8 o'clock, so I don't want to go on much longer, but Polly, you take us into the next phase of this discussion, and what, next week we'll talk about how the financial sector brought about, stimulated, accelerated the 2008 financial crisis. And certainly one comment that we could make is that the saddest thing from my perspective about Obama is that he brought in to his administration in key positions all of the same people who created the basis for the crisis.
Larry Summers et al. Yeah.
Yeah. I mean, I can't even explain it. I haven't read his book about his presidency, so maybe he explains it in his own book. But certainly there was a lot of reason to think out of the box at the time, and my view is that because Barack Obama was African American, that he seemed to go out of his way to want people in the financial sector to have confidence that he was one of them. That's my view.
Yeah, but otherwise it's very difficult to explain because he's obviously an extraordinarily intelligent man.
Yes.
My own sense is that he's a good man. He has a marvelous background in terms of his studies, for example. Yeah, I have a similar, but a bit different explanation. I don't know if it's correct, of course. And that is, he was afraid that he would be seen as an angry black man. You know,
I don't know so much about angry, but
yeah.
I mean, I have the same look when in my last years at Fannie Mae, our chief executive officer was a man named Franklin Raines, who was a Harvard educated black man. And he was committed to the social mission that we had, but he always made sure that we understood that he was committed to the shareholders and to returning, shareholder value. So he had to walk a fine line between wanting to do good in the communities where I was working and making sure that Wall Street analysts always were looking at our stock with the buy position, at least a hold or a buy. And so that really made it difficult for him, I think, to fully commit to some of our social missions. I suspect that the same holds true for Barack Obama.
Yes, Jerome.
Jerry.
Yeah.
Nice to see you, Jerry.
Nice to see you too. Just wanted to correct one thing. You had mentioned that the management is responsible to the shareholders. That is not true. The management is only responsible to itself. And that's the way it seems to work.
Yeah. Well, in the case of Fannie Mae, when the congressional hearings began, and there was investigation into some of the decisions made about whether or not the executives had been responsible only to themselves, they were ordered to give back quite a bit of money. But I don't know how universal that's been with regard to these corporate scandals, when, how many executives have been required to give back their massive compensation packages that they got.
They probably gave back 10%.
Yeah.
That's the normal thing for bankruptcy.
Yeah. Lobbyists write our legislation and they write it in the interests of their clients. And legislators often say that, they vote on legislation without having thoroughly read it. So I don't know.
They're only interested in being reelected.
Yeah. Dave?
There's a movie out called Margin Call on Netflix. So it talks about a firm like any investment firm and how they kicked out people, how they dealt with losing money at the time in 2008. I don't know whether you guys. We are about 11 minutes past the time. So if I can have a minute, I'd like to briefly introduce our upcoming speaker. It's part of a new series called Money Talks. Actually, it's just something that we are bringing back. We haven't done it for a little while. And we are starting this on Wednesday. And the speaker, Howard Switzer, is with us here. He's gonna take a few minutes ad from your time to introduce his session.
Hi, well, I don't know if I'll actually take a few minutes or not. I don't have that much to say, but I'd like to welcome everybody to come and learn about Silvio Gesell, if you're not familiar with him. And I did a presentation for the American Monetary Institute last year, and I was invited to share one here at Henry, Georgia, and I'm so honored to do that and be among you people who are looking at all this complexity.
Wasn't he?
I have a, yes, go ahead.
Wasn't he a Nobel Prize winner in chemistry, I think, and then got into economics?
No, that was
That's
Friedrich
Frederick Soddy.
Soddy. Yeah, that
Frederick
was
Oh,
Friedrich
Soddy was
Soddy.
the chemist. Okay.
Yes,
Sorry.
right.
My mistake.
Right.
Gazelli's
No,
people
Sylvia
use that.
Gassel was a merchant.
Roy,
Merchant.
are we doing anything for dinner? Oh.
You inviting
when
us
should
to
I come
dinner,
down?
Jerry?
Now? All right, I'm coming down.
I thought
See
maybe
how
you're
I get
inviting
out
us
of
all to dinner, Jerry.
Yes, so that's what we thought.
So there.
He's not listening to us any
Oh,
longer.
no, he's not responding at all.
Okay, well, listen, everyone, we'll pick this up next week. What we'll probably face with is 3 more weeks of this class. So I'll
Okay,
finish.
very good. Thank you, Ed.
Yeah, thank you all for participating. Really good questions and comments, and I thank Polly for the help with some of the issues I raised. So follow Ibrahim's lead and join the school for the session on Wednesday. I'm sure you'll learn a lot. I'm hoping my schedule will permit me to be on as well. Until then,
Bye-bye.
bye-bye.
Thank you very
Good
much.
night.
Hopefully, I'll see you all on Wednesday.
Bye-bye.
Bye.
Bye-bye.
Bye.